You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out.
Do you really want to be a great investor, but don't know where to start or what to avoid? Don't worry. We have put together 10 mistakes every investor makes according to Warren Buffett that you can avoid. Want to know what it is about? Do keep watching. Number 10. Not hiring a financial advisor.
Well, by far the best investment you can make is in yourself. I mean,
Financial advisors, often known as financial planners, are specialists who assist customers with wealth management and personal finance decisions. Financial advisors can assist you with anything from setting out a comprehensive retirement savings plan with a timeline to simply answering a query about whole life insurance, depending on their area of expertise. These services are occasionally compensated as a proportion of the investment assets under management. The price arrangement is sometimes a flat retainer. The investor and advisor would normally meet in person or virtually twice a year or quarterly under this arrangement, with the client having access to the advisor as needed for any queries or difficulties that may arise in the interval. The advantage of this type of agreement is that the investor not only has a professional looking after their money, but they also get guidance on their whole condition at key times. Number 9. Not understanding investing. Many self-investors believe in closely monitoring the winning stocks since they are unsure whether or not they want to invest in them. Investors might benefit from vicarious learning by developing a few methods before blindly investing in winning stocks. When it comes to mutual fund investing, remaining invested for a lengthy period of time pays off. However, the same does not apply to an individual investor. If stock pricing goes awry due to negative factors such as management's dishonest conduct, so it won't make much sense to sit here and wait for things to turn around. As a result, vicarious learning in stock investing teaches you to value investing by thoroughly analyzing companies on a variety of fronts rather than merely investing for the sake of it. Pain is felt significantly more strongly than pleasure. According to behavioral scientists, if we have had a terrible stock market experience in the past, we are more sensitive to the suffering. We may not want to sell underperforming stocks during this process since we don't want to lose any more money. And while we may continue to consider taking large profits from equities while holding on to terrible stocks, is this a viable strategy? As a result, vicariously learning students understand that in order to make good returns, it is necessary to critically examine underperforming stocks and get rid of them as soon as possible. Number 8. FOMO. This year has been a variety of whirlwind rallies, from Dogecoin's 12,000% spike in May to meme stocks like GameStop and AMC seeing their values more than tenfold increase in February. These gains sparked a frenzy among investors who scrambled to acquire a piece of the action. Despite the risk of purchasing high and selling low, a large number of people attended these rallies. Why? FOMO, or the fear of missing out, can lead investors to make riskier decisions than they would otherwise. According to Sherry Greco-Righteous, a wealth manager and behavioral finance specialist, seeing others make a lot of money on a stock or token that is experiencing a tremendous rally may make you feel pressured to get in and get a piece of the action, even if your logical brain is telling you that the best opportunities have already been taken. Number 7. Not planning. Investment plans are simply financial instruments that allow you to build a future savings account. One of the most important parts of an investment plan is that it instills financial discipline in individuals and allows them to make periodic investments into various funds that will help them meet their financial goals in the future. Investing is an important part of building wealth since it allows you to beat inflation, achieve financial goals, and stabilize your financial future at the same time. Financial goals are not all the same and vary from individual to person. The investor's risk appetite should be considered when making an investment decision, and the investor should also be familiar with the classification of investment plans based on various risk characteristics. Number 6. Not paying attention to fees. Although fees are an essential part of investing, that doesn't mean you have to spend too much on them. When circumstances are good, few people pay attention to their investment expenses, but what they don't understand that those bothersome small fees may eat away at their returns. Take, for example, a $100,000 investment portfolio. Fees of 0.50% each year for 20 years will diminish the value of your portfolio by $10,000. If the fees are 1%, the savings will be close to $30,000 over the same time period. There are a few simple techniques for investors to optimize their portfolios and cut investing expenses. However, before you can begin looking for strategies to lower your investing costs, you must first comprehend what they are. Fees cannot be avoided entirely. However, they can be minimized. Here are 4 ways to reduce your overall investment costs, ranging from pursuing low-cost funds to becoming more passive. Number 5. Being overconfident. According to research, many people are overconfident in their own investing talents, which encourages them to often trade in and out of different stocks depending on financial press headlines or their own market theories. We may recognize that most individuals cannot beat the market by trading regularly, yet we still believe we are exceptional. We may believe that because we read the news and make good decisions in other areas, we should be able to make sound investment decisions. Our overconfidence is exacerbated by the way we interpret new information. We tend to interpret it in a way that validates our past ideas. When investments are generally performing well during a bull market, we may conclude that our trading selections are generating larger returns. And when investments perform poorly during a bear market, we'll blame the market and maintain our idea that we're still good traders. Number 4. Chasing performance. According to Giorgio Metta, Group Co-Chief Executive and Global Head of Asset Management at Azimuth Group, performance chasing is a human mistake that we may all naturally make, based on the premise that we buy the winners and sell the losers. However, it always shows to be the wrong thing to do inside an organized professional portfolio management approach. According to Mr. Mehta, research suggests that selling assets on the days when markets have dropped the most in order to avoid poor performance is one of the worst moves an investor can make. Overall, he believes investors must have discipline and a strategy to remove their emotions from their decisions. Number 3. Not compounding returns. Interest is paid on investments such as saving accounts, GICs, and bonds. You know exactly how much money you'll make with these types of investments. By reinvesting your gains in other investments such as equities, mutual funds, and exchange-traded funds, you can still benefit from compounding. You may be able to decrease or eliminate the tax you pay on your earnings if you keep any of these investments in a registered account, such as a registered retirement savings plan or a tax-free savings account. You have $10,000 to invest over the next 3 years. You opt to invest this money in a mutual fund. Since you have a high risk tolerance, your investment increases by 5% the first year, loses 1% the second year, and increases by 7% the third year. The investment provides you with income in the form of payouts each year. Number 2, not reading account statements. You should receive account statements on a monthly or quarterly basis that reflect account activity and provide an update on your investments. You might get on your statements in the mail, or you might be able to access them online. When you receive your account statements, double-check the investments you bought and sold, as well as the fees and commissions you were charged. Also, keep track of how much money you've made or lost on your investments. If anything in your account statements is confusing or appears to be wrong, contact your financial agent. Many people lose a lot of money as a result of their failure to do so. Number 1, lack of diversification. When you diversify your portfolio, you include various asset kinds. Diversification can help to decrease portfolio risk by ensuring that the performance of one asset or asset class does not affect the entire portfolio. You can diversify your portfolio in 2 ways: across asset classes and within asset classes. When you diversify across asset classes, you distribute your investments over numerous asset classes. You could, for example, invest in bonds, real estate, and other assets in addition to stocks. When you diversify within an asset class, you spread your money over several different investments within that asset class. Finally, diversification allows you to blend assets with varying levels of risk in your portfolio. Stocks, for example, have traditionally yielded larger returns than bonds or cash, but they also carry a higher level of risk. On the other hand, while not producing the same high returns as stocks in the past, bonds might help mitigate some of the risks in your portfolio during years when the stock market is down. Did you find this video informative or helpful? Let us know in the comment section below. Make sure to subscribe so you don't miss out on my future videos. Don't forget to like and share.